Vetri Subramaniam, thank you so much for taking the time out and speaking to us. Neeraj here, good morning. What's your sense, Vetri? Is it possible to predict if we are done with the damage on the markets as yet?
There's no real forecasting tool that one can use to say that. As I think I've been saying in multiple forums over the past week to 10 days, valuations have certainly reached a fairly attractive zone today. But there's no way to tell whether, we've immediately seen a short-term low or not. But for long-term investors, what's important is that valuations are attractive. Trying to time the bottom, catch it perfectly, great in theory, but, 25 years of being in this market, it can't be done.
Okay. It can't be done. So, Vetri, then people would be, I'm just wondering, people would be wondering whether, while we all want to say you can't time the bottom, you try to buy something and it corrects further, it does leave a bit of a sad taste. The question is not the price question, but the time question. Since we don't know how protracted this would be, would it make sense to probably not go and deploy that 33% or 25% right now, but sit on it, let them trend reverse, and then try and go and buy into the quality names, because prices will not run away in a day or two, right?
Again, Neeraj, just looking back at my own experience of these kind of falls, this is not the first time we've seen stock prices fall, 30% in a month. It's happened before as well. There is no template that tells you whether the bottoming will take place in 3 months, 6 months, 18 months. If I just look at the last two instances, 2001, you could actually argue that the bottoming process played out over a period of almost, 15 to 16 months. If you think about 2008, 2009, the bottoming process played out over 6 to 8 months. But again, there's no formula that can one bring to this. This is what past history is, but every time might be different. But I think the point you made there is valid, which is to say, nobody is suggesting that you take all your firepower and deploy it in the market instantaneously. But let me just put this in context. Even an investor who was maybe running an asset allocation pattern of, let's say, 50-50 at the beginning of 2020, his equity portfolio is most likely down 30% or more. The debt portfolio has most probably stayed flat or appreciated. So even within the context of that portfolio, you can rebalance to go back to 50-50. And to those who are willing to take on more risk, I think this is the appropriate time to take it because valuations are attractive. 25 years of experience in the market, Neeraj, there's a very simple correlation. Cheap valuations, tremendous amount of uncertainty, costly valuations, everything seems like blue skies and people can see 20 years out. So this is the challenge in investing, but you've got to deal with it. But I'm saying at least you can put your feet into the water and rebalance what has already happened to your portfolio.
All right. So Vetri, good morning to you. On the back of that rebalancing, would you suggest that somebody who's probably extended themselves at the start of the year and deployed a little more money in equities versus fixed income should now, if they have additional capital, look to balance that disparity and put more money in fixed income so that they align equity and debt?
No, not more money in fixed income, because the percentage of fixed income in your portfolio has automatically gone up. So you actually take money out of fixed income and rotate it into equities today to bring your portfolio back to that 50-50 mix. So that's the direction in which you need to reallocate.
Okay. Aside from that, Vetri, now we are obviously at this juncture taking cues from what's happening from other markets. Unless and until things don't start improving there, which obviously looking at comments coming out from the White House, the possibility of cases peaking 2 lakh, this doesn't really augur too well in terms of the investment sentiment. And therefore, emerging market investment comes way down the line. Do you feel that before we don't see anything material coming out from the US, investment decisions into India will have to probably be more staggered than you would have anticipated?
So there are two parts to that, Davina. I think one is, of course, markets are correlated. They've been that way for many years now. But I think those who were there in the markets in 2000, 2001 or 2008, 2009 would again remember that all you got by trying to watch all the news flow and what was happening in other markets was sleepless nights, and going completely cross-eyed and bonkers trying to react to all those data points. So my suggestion is don't look at that. There will be correlations. This is a hyper market. Remember that the reason why there is money invested in stocks or other asset classes is because people are parking their surplus cash over there for some long-term objective. Now when you've got a disruption of the kind that you're having in the economies today, people are liquidating some of their investments to get cash back into their core activities. So when you hear about a sovereign wealth fund which might need to liquidate assets, it's because now there is a call being made from the core. This is normal. But the point being that those who have the ability, who have the wherewithal to make use of this opportunity should do it. And don't try to watch 20 news channels and 24/7 news flow across the world to take that determination. There is only one cycle which eventually matters in terms of your long-term investment outcome, and that's the valuation cycle. And don't lose sight of your asset allocation matrix. I am not by any stretch suggesting that you leverage to invest in the markets. I'm not suggesting that you increase your asset allocation dramatically. Stay within the confines of what you've determined. But most asset allocation models, including the one that we run, are suggesting that this is the time to start raising the allocation if you have the ability and the flexibility.
Vetri, now we've all seen how this particular period has thrown light to the damage that ETFs can do. I mean, at a time when everyone saw the benefits of ETF and the kind of liquidity and the flush of money that came into Indian shores, it's at an equally or even faster pace at which this ETF money has moved out. In light of that, as and when normalcy kicks in, do you anticipate much of the ETF money to be the reason or the leaders to lead the next rally?
Again, Devina, I mean, I don't want to make it sound like a history lesson, but there is always some money which is sort of moving around in and out of the market in a hurry, right? Go back to 2000 and 2001. It was the Badla position which really created the mess. And if you remember history, that is when India finally shut down the Badla system and said we'll move towards the stock futures system. 2008, 2009, it was the hedge funds who were moving money all over the world dramatically. They were the ones who were pulling it out dramatically. This time it's the ETFs. I mean, there's no point looking at the messenger. There is always going to be some player in the market who's more finicky than the others. They drive the upside volatility. They also drive the downside volatility. Sure, ETF flows have gone out, but in 2008, we were worrying about hedge fund flows. Outflows from some players in the market when prices are coming down is not unusual. This is where individual investors and investors who genuinely have the ability and the cash flow ability to stay the distance in terms of investing plans need to show that they can do something differently. So that's really the message that I would convey rather than focus too much on what our ETFs do.
And what about the fact that domestic institutions have been really supportive? So every time you've seen a big FII number, that's almost been matched by an equally large DII purchase.
That's true, and that goes back to the fact that I think the SIP pipeline has proved to be quite robust so far. I think all of us in the industry have been reaching out to investors to sort of handhold them and encourage them to stay the course. So I do think the ETF flows, the SIP flow is staying the course at this point. I'm also seeing a lot of the ETF money from PFs, etc., staying the course. There will be some investors who have to liquidate, simply as I said, because asset classes are the source of liquidity for those who are facing a challenge in their core business activity, or for that matter in running their households. So some of that is bound to happen, but I think the SIP flow remains encouraging, and that will continue to support the domestic markets to some extent. But again, these things keep changing over time. 25, 26 years of watching FII inflows in the market, the fact remains that except for 3 years, FIs have actually been net positive in Indian markets for 24 out of those 27 years. Whereas if you look at domestic flows, they were very, very irregular till about 2014, and then we've seen a change. So I would hope that the next decade would continue to see domestic flows being robust, but I would not write off the foreign inflows as yet.
All right. The other point being, now that we have seen these erratic moves with regards to fund activity, from a market standpoint, what is the one or two key variables that you will be watching out for? You already spoke about valuations, but anything else that one needs to monitor to figure out whether or not this particular issue is going to form a base? It's starting to form its base. May not be able to call the bottom, but the severity is petering off.
Sure, that's a great question. And, historically, I think what we've seen over time is that typically when you see this kind of a spike in the market, or rather a fall in the market, what actually spikes is volatility. And typically you get to a point where initially volatility tends to remain very high. It still is quite high, but over a period of days, weeks, months, you start to see the market volatility start to peter off quite a bit. That has typically been a good indication of the fact that the market's sort of trying to let's say the more hyper participants have exited the market and the market is starting to find its feet. I won't necessarily call it bottoming, but certainly a sign that the hyper volatile participants have exited, and stocks in a sense are now in the hands of people who are willing to think a little bit more long term. So I think from that point of view, volatility coming down, normally a good signal. The second thing, obviously from more economy and timeline point of view, we need to get past the lockdown. We need to see how normalcy will come back. Normalcy is not going to be the flip of a switch. It's going to be a gradual process of understanding how we can move back towards some sense of normality that we had in the early part of March. And I think as far as the economy is concerned, the historical indicators which have indicated consumer confidence coming back is the trend in consumer durable purchases and auto purchases. And increase in credit normally means the economy is getting lubrication, and that's again a lead signal that you will start to see economic activity pick up.
Right, Vetri, great to hear those thoughts from you. Thank you so much for joining us this morning on Bloomberg.
Thank you so much.